Welcome back to Mastering MHA, MBA. We are continuing Chapter 9 from Datar and Rajan's Managerial Accounting. This is part 3 of 5, 3 learning objectives in one video. Capacity constraint product mix, the theory of constraints for managing bottlenecks, and the decisions every business eventually faces: drop a customer, add a customer, close a branch, open another one. Quick orientation. Part 1 covered the relevance test. Part 2, Opportunity Cost and Make or Buy. Today, Learning Objectives 4, 5, and 6. Part 4 picks up Equipment Replacement and Joint Costs. Part 5 closes with the Linear Programming Appendix. Learning Objective 4. When capacity is constrained, the right product to produce is not the one with the highest contribution margin per unit. It's the one with the highest contribution margin per unit of the constraining resource. That distinction is what trips up most product mix decisions in practice. Power Recreation assembles snowmobile and boat engines at one Kentucky plant. Snowmobile engines have a $240 contribution margin, 30%. Boat engines, $375, 37.5%. On per unit terms, boat engines look more profitable. The naive call is make boat engines. 600 machine hours are available daily. That's the constraint. A snowmobile engine takes 2 machine hours. A boat engine takes 5. Convert contribution margin into contribution margin per machine hour. Snowmobile, 240 divided by 2, 120 per hour. Boat, 375 divided by 5, 75 per hour. At full daily utilization, snowmobile engines yield 72,000 in contribution margin. Boat engines only 45,000. The lower per unit margin product wins because it uses the bottleneck more efficiently. The principle generalizes. The constraining resource might be machine hours, direct material, skilled labor, financial capital, sales effort, or in retail. Linear feet of shelf space. Whatever it is, the rule is the same. Maximize contribution margin per unit of the constraint. With multiple constraints active simultaneously, the math gets harder. That's where linear programming comes in, which we'll cover in Part 5. Learning Objective 5, Theory of Constraints, a methodology for managing operations where some steps are bottlenecks and others aren't. Originated in manufacturing in the 1980s. 3 core measures: throughput margin, investments, operating costs. Throughput margin is revenue minus direct material cost. Investments are working capital and capital equipment costs. Operating costs are everything else. The objective: increase throughput margin while reducing investment and operating costs. Now suppose snowmobile engines must go through forging before assembly. 1200 forging hours available daily, 3 hours per unit, capacity 400. 600 assembly hours, 2 hours per unit, capacity 300. The system can only output 300 snowmobile engines per day because assembly is the bottleneck. Forging more than 300 just builds inventory. That's how a bottleneck is identified. Large work-in-process queues form just before it. The theory of constraints process. Step 1. Recognize that the bottleneck operation determines the contribution margin of the entire system. Step 2. Identify the bottleneck operationally. Look for inventory pileups. Step 3. Keep the bottleneck busy and subordinate every other operation to it. Forging shouldn't try to make 400 snowmobile engines a day. It should make exactly enough to feed the assembly station with a small buffer. Step 4. Invest in the bottleneck whenever incremental contribution margin exceeds incremental cost. Concrete actions to relieve the assembly bottleneck. 1. Eliminate idle time. Power Recreation evaluates positioning 2 extra workers at assembly to unload finished engines and set up the next batch. Cost: $320 per day. Benefit: 3 additional engines per day at 240 contribution margin each, 720 per day. Take the action. Net benefit: 400 per day. 2. Shift work off the bottleneck. Spartan Corporation offers to assemble 5 extra engines per day at $75 each, $15 more per engine than Power Recreation's own cost. Take it. Why? Because every assembled engine adds 240 in contribution margin. Net benefit is contribution margin $1,200 minus assembly cost $375. $825 per day. The fact that Spartan charges more per engine than Power Recreation's internal cost is irrelevant. Now contrast, Gemini offers to forge 8 engines per day at $65, $15 below Power Recreation's own forging cost. Don't take it. Forging isn't the bottleneck. Outsourcing forging adds cost without adding any output. Cheaper isn't better when it's the wrong operation. 3. Reduce setup and processing time at the bottleneck. A $1,000 per day investment in faster assembly setup yields 10 more engines daily, $2,400 in contribution margin. Net benefit $1,400. Take it. The same investment at the forging station is a no. Forging isn't the bottleneck. More output there just builds inventory. 4. Improve quality at the bottleneck. 5 defective engines at forging cost $2,800 in wasted direct materials. 5 defective engines at assembly cost the same $2,800 in materials, plus $1,200 in lost contribution margin from the bottleneck capacity wasted on defects. Total $4,000. Inspect aggressively before the bottleneck. Quality programs should focus on whatever station is the constraint. A subtle point. If the actions succeed, assembly capacity eventually exceeds forging capacity. The bottleneck moves to forging. Now the Gemini outsourcing offer that was rejected earlier becomes attractive because it adds output. The bottleneck always shifts after improvement. Manage continuously, not statically. Theory of constraints is a short-run framework. It treats operating costs as fixed and focuses on maximizing throughput at the bottleneck. Activity-based costing is a long-run framework. It drills into individual activities and their drivers and is more useful for pricing, cost control, and capacity management decisions over years. The two are complementary. TOC for this quarter's output, ABC for next year's strategy, translating to healthcare. Emergency department throughput. Bed availability is usually the bottleneck. The lever is faster discharge from the inpatient floor and standing up an observation unit. Operating room throughput. Turnover time and anesthesia induction are common bottlenecks. The lever is parallel induction in a second room. Imaging volume, scanner schedule capacity. The lever is extended hours and one Tech 2 room scheduling. Different operations, identical mechanics. Learning objective 6. The same relevance machinery applied at the customer level. Adding a customer, dropping a customer, opening a branch, closing a branch. The principles don't change. Ignore allocated overhead, focus on incremental and opportunity costs. The textbook's Allied West case. Allied West is the West Coast sales office of Allied Furniture. 3 customers, Vogel, Brenner, Whisk. Activity-based costing assigns costs to each customer based on the activities supporting them. Look at the bottom line. Vogel makes $9,000, Brenner $16,000, Whisk loses $32,000. The total office posts a $7,000 loss. Should Whisk be dropped? What goes away if Whisk is dropped? Cost of goods sold, furniture handling labor, marketing support, sales order, and delivery processing. All variable with Whisk's activity. What stays? Warehouse rent, general administration, allocated corporate office costs. These are fixed regardless. Equipment depreciation is sunk and irrelevant either way. The space and equipment go idle. Exhibit 9-9, column 1. Lost revenue $400,000. Saved cost $385,000. Net operating income effect minus $15,000. Dropping Whisk makes Allied West $15,000 worse off. Keep Whisk. Find ways to make the account more efficient. Bigger orders, fewer deliveries, higher prices. The $32,000 reported loss is misleading because it includes allocated overhead that doesn't actually go away. A twist. Suppose Sanchez Corporation will lease the freed up space and equipment for $20,000 a year. Now the opportunity cost of keeping Whisk is $20,000. Drop Whisk and Allied West loses $15,000 from operations, but gains $20,000 from the lease. Net gain $5,000. The decision flips. The freed up resource has to actually have an alternative use for opportunity cost to count. Now consider adding Loral, a customer with a profile much like Whisk's. No other use for Allied West's facility, so opportunity cost is 0. Same revenue and cost structure as Whisk, except this time Allied West has to acquire new furniture handling equipment for $9,000. That $9,000 is relevant. It's a future cost that would not be incurred without Laurel. With Whisk, equipment depreciation was a past cost and irrelevant. With Laurel, the new equipment is a future cost and relevant. Net operating income effect of adding Laurel plus 6,000. Add Laurel. The most subtle distinction in this chapter. Equipment depreciation appeared on both decisions. In the drop whisk analysis, it was irrelevant. The equipment is already bought. Depreciation happens regardless. In the add Laurel analysis, the new equipment cost is relevant. Allied West would only buy that equipment if Laurel signs. Past cost is sunk. Future cost incurred only under one alternative is relevant. Same line item, opposite row. This is the part students fail on tests. Now zoom out. Should Allied Furniture close Allied West entirely given its $7,000 reported loss? Lost revenue $1.2 million. Saved costs $1.158 million. Every variable cost goes away. But corporate office costs are unchanged because the $24,000 allocated to Allied West just gets reallocated to other offices. Net operating income effect minus $42,000. Closing Allied West would make the parent company $42,000 worse off. Keep it open. Allied Furniture has the chance to open another office, Allied South, with the same profile as Allied West. $25,000 in new equipment is relevant. Corporate office costs don't change because Allied South just absorbs some of the existing allocation. Net effect plus 17,000. Open Allied South. Same logic as adding Laurel at the office level instead of the customer level. Datar and Rajan emphasize, and so will I. Allocated overhead is almost always irrelevant. The corporate office allocation that hits Allied West changes who's hit, not the total cost. 24,000 allocated to Allied West today. 24,000 allocated elsewhere if Allied West closes. Same total, irrelevant. The only time allocated overhead is relevant is when total allocated overhead actually decreases, i.e., the corporate office gets smaller. That rarely happens because of one branch closure, translating into healthcare. Drop an unprofitable payer contract. Relevant cost is the freed up revenue cycle and network management capacity. New employer self-funded contract. Relevant is incremental IT and administrative cost. Close an underperforming clinic. Relevant is everything that actually goes away, not the corporate overhead allocation. Open a new outpatient site. Relevant is the capital depreciation on new equipment, plus the operating costs that wouldn't otherwise be incurred. Same chapter, different objects. Keys to success. When resources are constrained, maximize contribution margin per unit of the constraint, not per unit of product. Increase bottleneck utilization, efficiency, and capacity. For customer level decisions, focus on incremental costs and opportunity costs. Ignore allocated overhead unless the total allocation actually changes. To recap, under capacity constraints, the right product is the one with the highest contribution margin per unit of the constraint. Theory of constraints manages bottlenecks short run. ABC manages cost structure long run. Customer level decisions, drop, add, close, open, turn on incremental and opportunity costs. Allocated overhead is almost always a red herring. In part 4, we move to equipment, replacement decisions, and joint costs, both classic relevance traps. Thanks for watching Mastering MHA MBA, based on Datar and Rajan's Managerial Accounting First Edition.